Hi, and welcome to Counting Like It's 1479. Lots of people sell a certain type of derivative, called a covered call option, as a way of squeezing some extra money out of the stocks in their portfolio that aren't really appreciating a lot. What I've noticed is that there's a lot of confusion from people about how to represent these call options on their ledgers. The question comes up on Reddit and other forums regularly. Let's talk about how to do it. I'll briefly explain what a covered call is. A call option is a contract. The buyer of the call, called the holder, pays the seller some money, called a premium. In return, the seller of the call, called the writer, gives a promise to sell the shares in the future at a price determined today, called the strike price. Usually, though not always, that price is higher than what the stock is at today. A call is covered when the seller already owns the shares they're promising to sell. The premium is being paid because it allows the buyer to purchase the shares later after the price has changed. The psychology of call options is that the buyer believes that the price of the shares will go up over the strike price, so they think they'll be getting a bargain. The seller believes that the shares will not go up. Each party thinks they're going to make money, but neither knows for sure. It's not even required that the seller own the shares they are selling the option for. But if the buyer exercises the option, the seller has to sell the shares and buy shares if necessary to fill the order, no matter what the price is. Some people like options because since they're cheaper than trading the underlying securities, they're a cheap way to get leverage and trade more than you can afford. This is why options trading is one of the easiest ways to lose your shirt, and I'd advise most people to stay away from it. But of all the types of option trades there are, selling covered calls is generally considered pretty safe. In a covered call, you write the call option on shares that you already own. So the worst case scenario is that you lose the difference between the exercise price of the option and the market value of the underlying shares, minus whatever premium you were paid. But you didn't want to know my opinion on options, you just want to know what journal entries to write for them. So let's get down to brass tacks, or income tax as the case may be. The single most important reference you need to account for these options is IRS Publication 550, available at the URL you see on screen. Specifically, you want to read the section on puts and calls. This document has a fantastic table, Table 4-3, which shows you exactly how the IRS wants you to treat these transactions for tax purposes. Unsurprisingly, my recommendation is that you write journal entries that make meeting these obligations easy. That said, nothing in this video is tax or accounting advice, and you should always talk to your accountant if you're unsure. So let's say Alice, remember Alice, bought 100 shares of Bigco stock for $10 and sells a single Bigco call with a strike price of $15 for a premium of $5. We debit her account with the cash, but we do not recognize the income at this time. Instead, we credit a liability account that recognizes that the call is still open, representing our promise to deliver. You might ask, why isn't the liability in the amount of the price of the underlying security? And the answer is that since this is a derivative, that hypothetical transaction doesn't exist yet. Only the promise that it might exist does. So that's what we account for. If in a month the price of Bigco has gone down a bit, the call is never exercised and the option expires. This is the easy case from a bookkeeping standpoint. The liability vanishes in a puff of orange smoke, and Alice books the $5 premium as a short-term capital gain. We debit the liability and credit short-term cap gain. But what happens if the price of Bigco has gone up, let's say, to $20 a share? In that case, the buyer or holder will exercise the option. They'll pay the writer the $15 a share strike price agreed on, or $1,500, and in return the writer will have to deliver 100 shares of Bigco worth $2,000 to the holder. Here's one possible journal entry showing the transaction. Alice receives $1,500 into her bank account and keeps the premium, but instead of keeping the full $1,000 gain from selling Bigco shares at $20, she offsets the gain taken by the holder. In this case, she made $505 on her Bigco shares instead of $1,000. And that's what I wanted to tell you about today. This has been Counting Like It's 1479. If you'd like to hear about how to account for other types of transactions, please leave a note in the comments. Thanks for watching.